Hello everyone, this is Professor Fang. Today we are going to talk about Palantir. So Palantir just reported another incredible quarter. If you look at the numbers, they are crazy, right? Revenue grew 93% year over year, and US commercial revenue grew 149%. GAAP GAAP operating margin reached 47%. So a lot of people may think, okay, this is another great report. So the stock price explode by 40%. But I don't think that's the reason. If good earning itself is enough, why Palantir dropped significantly since Q1? The answer is that the market never worried about Palantir's current revenue. The market for this high growth company was always worried about what would happen after the current revenue. This is the point I want you to learn from this video, and it will help you to evaluate the rapid growing company like Palantir. I'm not a financial advisor. This video is my personal study and for the entertainment purpose only. So let's first of all look at the numbers. So what actually changed from Q1 to Q2? Let's put the data for Q1 and Q2 side by side. So everything seems to be improved. The revenue growing from 85% to 93%. US commercial growth accelerated from 133% to 149%. Margins improved, cash flow improved. But those are not the number I'm looking at. I'm looking at the three key numbers. One is total contract value, TCV. It went from about 1.18 billion in Q1 to 2.13 billion in Q2. So that's an increase roughly 81% in a single quarter. Another number is called remaining deal value, RDV. It goes from $4.92 billion to $6.24 billion, a 27% increase over one quarter, right? And another number that I'm looking at is remaining performance obligation, RPO. It improved from 4.45 billion in Q1 to 4.9 billion in Q2. Why not we looking at the revenue? Revenue is eventually what we are looking for. We put money into the company. We want it to generate revenue, generate eventually profit. Why we're looking at those three values? Now we look at the mental picture for rapidly growing companies. So the easiest way to understand these numbers in the context of Palantir's business is think about the Palantir's business as a big reservoir, right? What's the outlet from that reservoir? It's the revenue, right? And then that's eventually what you're looking for. But for this rapidly growing company, people are not looking at the current revenue, they're looking at the potential revenue in the future. If you look at the reservoir and you want to predict the outflow in the future, what number, what quantity you will look at? You will look at the inflow. That's exactly the TCV looking at, total contract value. Imagine Palantir signed another 3-year contract worth $30 million. So Palantir doesn't report $30 million as the revenue right now. It may recognize that revenue gradually over time as the software and the services being delivered, right? So that's $30 million and not the revenue for now or the inflow. That's the TCV. TCV essentially tells us how powerful the inlet is. So another number, remaining deal value, RDV, is also very useful. So if TCV represents the water inflow, RDV is closer to the amount of future deal that's still sitting inside the reservoir. And remaining performance obligation, RPO, is a more conservative measure of that. So it represents the contracted, non-cancelable revenue that Palantir has not yet been recognized. So essentially, the three numbers, one describes the inflow, another are the two kinds of measure of how much water you have in the reservoir. If you want to predict an outflow, which is the future revenue growth, and you see the water level in the reservoir is increasing and the inflow is crazily increasing, you are comfortable, you are happy because you know that in the future, the outflow will be bigger. So in short, TCV tells you how much water is entering. RGV tells you how much future business is still stored in the system, and RPO tells you how much future revenue is more firmly locked in the reservoir. And the revenue is the water coming out of that reservoir today. So if TCV, RGV, and RPO eventually slow down. Even though the revenue looks good and will be good for a while, in the future you know that the reservoir is drying out and the outflow, which is the revenue, will eventually become bad. So that's actually what a lot of the investors looking at right now. They're not looking at the outlet, they're looking at the inlet and the reservoir itself. If you like this kind of like a fundamental hardcore analysis, please subscribe and share this to your friends. Now look at Palantir's business model and how Palantir has found a way around its biggest bottleneck. So you see a reservoir with increasing inlet flow and the reservoir water is increasing and outflow flow are increasing. But how did Palantir do this? So traditional SaaS software can sometimes scale very rapidly without human involvement. Imagine that you create a course or create a service that is digital, you sell to 1 people, sell to 1 million people, 1 billion people, eventually the cost is roughly the same. So that's the beauty of the SaaS business model, right? You build something and you essentially can sell to everyone. But Palantir is different. So the deployment has historically heavily dependent on forward deployed engineers, FDEs. So these engineers go directly to the customer organization, collect data, understand the workflow, and build applications, eventually deploy the service. And there is an obvious bottleneck. FDEs are limited. You can double your revenue, but how can you double FDE in short time? They are humans, they need training. Actually, the number tells us how Palantir go around this. So in Q1, Palantir have 615 US commercial customers. And in Q2, the number increased to 653 customers. So the number of customers not increased, it's only 6%. But remember what happened to the US commercial TCV, it increased 81%. So there's only one way to go around this, which is that they're not expanding their TCV by increasing the number of customers. They are offering more services to the existing customers. It's measured by net dollar retention. That tells us the net dollar retention increased from 150% in Q1 to 157% in Q2. So what does the number tell you? That simply tells you that Palantir's existing customer base is spending dramatically more money on Palantir. So their growth engine, instead of being find more customers, because their engineers are limited, their business model actually is land a customer, prove the product work, we offer you something, and your efficiency increased significantly and massively expand inside their existing customer. So that's how they work around their FTE limitations. However, the biggest questions is still ahead. We should keep observing and adjust our position. I think Palantir has two key risks. One is growth may have peaked. So no one will grow infinitely because the planet is only finite sized, right? Even though it's big. Eventually, Palantir will reach a plateau. Their growth will be steady. When is that point and what be that peak value is something that we're looking for. We will keep observe that. Another is the long-term risk. AI may eventually destroy Palantir's moat. So the Q2 did not eliminate either risk, but it weakened both of them, so that the valuation correct and the stock price bounced by 40%. And for Palantir, we should observe four numbers: TCV, RGV, PRO, and also NGR. That what tells us whether the revenue is peaked. If we want to know the future of Palantir, it's good to look at some historical company that looks similar to Palantir, even though the technology is totally different. A decade ago, Netflix was one of the hottest growth company on the stock market. Before Magnificent 7, it was called FAANG, F-A-A-N-G, and Netflix was that N. So there are three stages for Netflix. And by definition, I think Palantir will go through similar logical paths. The Netflix first stage was from 2013 to 2018. During that period, the company's business accelerated, while both the stock price and the valuation generally moved higher. At one point, Netflix PE value reached nearly 400. That's like a crazy. But that extreme high valuation did not stop the stock from rising. Actually, over 5 years, the stock increased roughly tenfold. So the second stage was from 2019 to 2022. This was the period where growth peaked and began to slow. The company was still growing, but it was no longer accelerating. This valuation has started to compress, the PE ratio falling from 100 to about 60. And meanwhile, the stock experienced two major drawdowns, roughly 40% each. Volatility increased and the upside became more limited. Even so, this was still a growth phase, and the stock roughly doubled over those 3 years. So the third stage came after 2022. At that point, the company's business weakened significantly, and the subscriber growth even turned negative for a period of time. Its valuation fell from around 60 times earning to as low as 16 times, while the stock dropped as much as 75% from its peak. Later, Netflix found new growth driver and the stock recovered, of course, but that's a different story, not what we are focusing right now. So from these three stages, we can identify two typical characteristics of stock going through period of valuation digestions. So the stock tend to follow the direction of the revenue growth rather than the absolute value of the level of growth. So the level of growth is a number. The market is actually looking at the trend of that revenue growth number. So when the revenue growth is accelerating, the stock generally tends to be higher, right? Once the growth starts to slow, however, the stock often stops making sustained progress. It may trade sideways or decline, and the volatility becomes higher. Second, the real turning point is not how the growth rate eventually falls. The key is when the growth going to a steady state. As long as the growth continues to slow, it's difficult for the stock to establish a forward trend. Once the growth stabilizes and the market can finally identify company's steady state growth rate, and the valuation can find a new anchor. So from there, the business growth can once again begin to drive the stock higher. So it's like a rapid growing phase, and then you are looking at higher order derivatives. And once it's steady, you have to find another anchor. So I believe Palantir will follow the similar pattern. May not be the same three stages. Maybe the order will shuffle, will go back and forth, but the logic will always be the same. And you have to look at those four numbers I mentioned and observe the reservoir income, water level in the reservoir, and also the outlet. Of course, because of the Palantir's unique business model, you have to observe whether their existing customers are paying more. So that's the video for today. If you like this hardcore analysis, please subscribe and share to your friend. I'm Professor Pham. I'll see you next time.